Why is it that every recession quietly mints new millionaires, while people like you and me are the ones panicking on WhatsApp, checking our portfolios, and wondering if this is the end? Because recessions are not just crashes, they are wealth transfers. Money doesn't disappear, it changes hands, usually from the scared and unprepared to the calm and prepared. And unless you understand how that transfer works, you'll keep ending every crisis poorer while a tiny group walks out richer every single time. So in this video, let's answer one uncomfortable question. How do some investors come out of recessions richer? And how can a normal person with a normal salary position themselves on the winning side next time? Imagine two friends in 2008. Same age, same job, same salary. Both had been investing for a few years. Then the headlines start, financial system on the brink, global markets in free fall. Stocks are falling 5%, 7%, 10% in a day. Investor 1, let's call him Arjun, opens his brokerage app, sees his portfolio down 40%, and thinks, I can't watch this anymore. I've worked too hard for this money. I'm out. He sells everything, moves to cash, and promises himself he'll get back in when things look safer. Investor 2, Mira, sees the same 40% drop and does something that feels almost stupid. She keeps investing the same amount every single month. Markets fall more. She's down 50%. She still buys. Friends call her crazy. Her parents tell her to stop throwing good money after bad. She keeps going. Fast forward 10 years. Arjun is still waiting for a better entry point and talks about how markets are rigged and the rich always win. Mira's net worth has quietly exploded, not because she got lucky, but because she understood one idea that most people never really get. Recessions are when assets go on sale. That's the first mindset shift you must make if you want to come out richer after the next downturn. When you walk into a mall and see flat 50% off, you don't run away from the store screaming, "It's crashing!" You get excited. You start thinking, what can I pick up that I couldn't justify at full price? But when the stock market goes on a 30 to 50% discount, people react as if that's the end of capitalism. The same businesses, the same factories, the same software, the same real estate, just marked down because everyone is scared at the same time. Historically, every major crash has eventually been followed by a recovery, often with some of the biggest positive days happening right next to the worst negative days. Miss those big up days and your long-term returns fall off a cliff. This is where most people sabotage themselves. When markets crash, they say, I'll sell now and get back in when things calm down. But the data shows that the calm never sends you an email. The bottom doesn't ring a bell. By the time things feel safe, a huge part of the rebound has already happened. There's even research showing that if you just miss a small handful of the best days in the market, which often happen very close to the worst days, your overall returns get wrecked. In other words, if you run away during recessions, you're systematically missing the very period when the rich are making their future gains. So what did Mira do differently from Arjun? She didn't try to guess the bottom. She just kept buying through the pain. A simple strategy called dollar cost averaging. Instead of dumping a big lump sum at some random time, dollar cost averaging is when you invest a fixed amount regularly, every month, every salary, regardless of whether the market is up, down, or sideways. When prices fall, that same amount buys more units. When prices rise, it buys fewer units. Over time, your average cost gets smoothed out. Here's why this becomes insanely powerful in a recession. Suppose you invest the same amount every month into a broad market index fund. As markets crash, your emotions scream, stop, but your system is quietly buying more and more units at lower prices. When the recovery comes, those extra units bought in the darkest months are exactly what drive your portfolio higher. And here's the punchline. Even people who invest at the worst possible times have historically ended up doing well if they simply never sold and kept the money in. There's a famous example known as Bob, the world's worst market timer. Bob started investing in the 1970s and had a magical talent for always buying at market peaks right before major crashes. He put in his savings at the peak in the early 70s, then crash. He waited years, saved up again, invested at the peak in 1987, then crash. He waited again, invested big in 1999 at the height of the dot-com bubble, then 50% crash. He did it again before the 2008 financial crisis and saw his portfolio drop more than 50% on paper. But here's what Bob did that almost nobody does. He never sold. He never panic sold at the bottom. He just left his investments alone and kept working. By the time he retired, despite the fact that he only invested at the worst times, Bob still ended up a millionaire with solid long-term returns. Why? Because time in the market beat his terrible timing of the market. If the world's unluckiest investor can still win by not touching the sell button, you and I don't need perfect timing or secret information. We need discipline. But let's address the obvious objection. How do you expect me to keep investing in a recession when I might lose my job? I'm already stressed about paying bills. This is where the real edge of rich investors shows up, and it has nothing to do with IQ. It has to do with cash reserves and emotional control. Think about who becomes a forced seller in a recession. It's not the person with a 6 to 12-month emergency fund sitting in cash. It's the person who has no savings, lots of EMIs, and a job that suddenly looks shaky. When something goes wrong, job loss, medical issue, business slowdown, they have no cushion. So what do? They are forced to sell their investments at the worst possible time just to survive. Meanwhile, the people with cash reserves are looking at the same crash, but from a completely different position. They're not wondering, how will I pay rent next month? They're asking, what quality assets can I buy right now at 30 to 60% off? This is the hidden game. Recessions are not just about who knows more. They're about who can stay calm because they don't need to sell. Cash is not just about safety. Cash is optionality. It gives you the option to buy when everyone else is being forced to sell. And that's exactly what rich investors do, from the Great Depression to 2008 to the COVID crash. Look at 2008 to 2009. Housing prices in many places got smashed. Foreclosures spiked. Regular families lost their homes. Who stepped in? People and firms with cash and access to credit. Wealthy individuals, private equity, large investors bought properties for cents on the dollar. 10 years later, those assets had multiplied in value, while the families who were forced to sell never fully recovered. During the COVID crash in 2020, markets dropped around 30% in weeks. Millions lost jobs. At the same time, billionaire wealth actually increased by hundreds of billions of dollars as markets recovered and stimulus pushed asset prices back up. Same crisis, completely different outcomes. So what exactly are rich investors doing in recessions that most people are not? First, they focus on buying quality assets on sale, not random lottery ticket stocks. They look at strong businesses with durable cash flows, diversified index funds, solid real estate in good locations, and even entire businesses that are temporarily distressed but fundamentally sound. Second, they don't go all in at once. They spread their buying over time, just like dollar cost averaging, because they know they can't predict the bottom either. Third, they keep cash or low-risk assets like high-quality bonds before and during late-stage booms, so they're ready when a downturn hits. They're not 100% in the hottest speculative stocks at the peak. Fourth, they diversify. They don't bet everything on one company, one property, or one sector. Index funds, broad ETFs, and diversified portfolios reduce the risk that any single failure blows them up. And finally, they play a different time game. They're thinking in 10 to 20-year horizons, not 10 to 20 days. So short-term price drops are just noise, not emergencies. There's another crucial point people miss. Historically, different asset classes behave very differently around recessions. Stock markets might crash hard, but government bonds or defensive sectors can hold up or even do well, creating a cushion in a diversified portfolio. That's why many long-term investors use a mix like 60% stocks, 40% bonds, not because it's sexy, but because it suddenly feels a lot safer when markets tank. You don't panic sell as easily when only part of your portfolio is getting hammered. So if you are a normal person, no family office, no private equity, no special access, What can you actually do to come out richer after the next recession instead of crushed? Step 1. Build a boring emergency fund. This is not wasted cash. This is your emotional shield. Aim for at least 3 to 6 months of essential expenses, and if your job or industry is unstable, push that closer to 6 to 12 months. Step 2. Decide your recession playbook before the recession. If you wait until the panic starts, you will react emotionally. Write down rules like, I will keep investing my monthly amount even if markets fall 50%, or if the market drops more than 30%, I will increase my monthly investment by X% as long as my emergency fund is intact. Step 3. Use automatic investing. Set up a system that invests a fixed amount into a diversified fund every month, so it keeps working even when your brain is screaming to stop. Automation helps you behave like Mira, not Arjun. Step 4. Focus on broad quality assets, not speculative gambles. Total market or large cap index funds, diversified equity funds, maybe some bonds. These are the kinds of instruments that have historically recovered strongly after recessions. Step 5. Avoid becoming a forced seller. That means managing your debt, avoiding over-leveraging on hot trends, and not putting money into markets that you'll need in the next 1 to 3 years. If you need that money soon, for a house down payment, tuition, or a wedding, it does not belong in high-risk assets that can drop 30 to 50% right before you need it. Let's tie this back to the original question. How do some investors come out richer after recessions? Because while most people are selling their assets to survive, these investors are buying those same assets at fire sale prices with money they don't urgently need. They have cash reserves, they have a plan, and they have the emotional control to stick to that plan when it hurts the most. And as markets recover, which historically they always have after past recessions, the ownership of those assets is now concentrated in fewer hands. That's the wealth transfer. It's invisible month to month, but obvious when you zoom out 10 years later. You don't need to be a genius. You don't need to predict the next crash date. You just need to avoid the 2 big mistakes: selling out in panic, C, and not having cash when the bargains appear. If you do only 3 things right: keep your emergency fund, stay invested through recessions with a diversified long-term strategy, and, if possible, buy more when everyone else is terrified. Then the next recession doesn't have to be the moment you lose wealth. It can be the moment you quietly build it. But there's one more brutal truth you need to hear. Most people think they'll be rational in a crash until it actually happens. It's easy to watch old charts and say, I would have bought there, but in real time, the news is screaming that this time is different, politicians are fighting on TV, and your friends are sending you screenshots of their losses. So don't rely on willpower, build friction around bad decisions. That might mean deleting trading apps from your phone, turning off market notifications, or setting a personal rule that you can't sell anything within 24 hours of feeling panic. Give your future self the chance to calm down before doing something irreversible. You can even flip the script. Instead of asking, how much have I lost during a downturn, ask, how many extra units did I just buy this month because prices are lower? That tiny reframing turns fear into opportunity and keeps you focused on ownership, not short-term price. And remember, coming out richer after a recession doesn't only mean making more money from the stock market. It can also mean using downturns to level up your skills, start a side hustle, or negotiate better opportunities while others freeze. Recessions shake up the status quo. The people who move, learn, and act during that chaos often come out with better careers, better businesses, and a stronger financial base. So when you think wealth transfer, don't just picture charts and candlesticks. Picture who is learning, who is buying, and who is preparing while everyone else is doom scrolling. That's the group you want to quietly join, because recessions will keep happening. The only real question is, next time, will you be the forced seller or the calm buyer? If this changed how you think about recessions even a little, don't just click away and forget it. Hit subscribe so you don't miss the follow-up videos where we break down actual recession-proof portfolios. Share this with one friend who always panics during crashes. And in the comments, tell me honestly, in the next big downturn, What's one rule you're committing to follow?